Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So, the non-farm payrolls report, the jobs number that comes out every first Friday of the month, came out hotter than expected, right? And the reaction from stocks and bonds was initial knee-jerk down and a complete sell-off where those bond yields, especially on the long end, the 30-year, spiked up to 5%. And it stayed there for a bit until later in the day, it completely did a U-turn, right? Bonds came back down. Bonds went back up, yields came back down, and stocks that crashed initially on that reaction went back up to price level one. Now, why? Right? Jobs came in really strong and everything was selling off. Bonds were selling off because, hey, that means that the Fed needs to do more tightening. Stocks were selling off because those yields were going up, right? But then completely reversed the move. So I thought, we were in a environment where good news is bad news. Because if good news means that, you know, um, more tightening is coming, then you should not be buying stocks. But that wasn't the case later in the day. We did get a reversal. And the main point I would say is why we got that reversal was because part of it had to do with the average hourly earnings. The average hourly earnings, which has to do with wages and inflation expectations, that came in lower. So it kind of basically gave this Goldilocks scenario, this soft landing scenario that, hold on, let me think about this for a second. Jobs came in stronger, and you're telling me inflation's coming lower? So the economy is doing fine while inflation's coming down? Oh, we should buy this dip. And that's what happened in the equity market and in the bond market, where it completely reversed the move because it was that soft landing narrative. It was that, hey, things are fine. And lo and behold, later, in the week, we got some inflation data as well. Well, PPI came in stronger than expected, but not that strong. Again, it was shrugged off as well. But you got the messages from the Federal Reserve saying that, hey, a week later, that 5% that we saw, it kind of did tightening for us. That was equivalent to a rate hike. So we may not have to hike rates. Now, that doesn't mean that they're done, right? If this data continues to come in stronger, inflation numbers come in stronger, jobs number come in stronger, for now, this may be bought as the soft landing. Eventually, at one point, there will be no soft landing if the data continues to be hotter and you get the Federal Reserve or the reaction of continuing to tighten hard and hard and hard. And this is where I believe, being October, November, December, where things are going to get a little bit confusing because you're going to get data that may come in hot, may come in weak, might be a mix of blend of both, but the Federal Reserve starting to communicate that they're watching and they're waiting and they will adjust accordingly. So just like we just saw recently from the Federal Reserve saying that this pause is, we're thinking that, there's no need to hike further, that just may mean for the next 3 months of this year. That can definitely change come January. Now, there was a Bloomberg article also that came out saying that this will be probably the last jobs number that come in hot. That means the next coming ones are expected to be weak. So if the next coming ones are expected to be weak, shouldn't that also be good for bonds and stocks? Wouldn't that push bonds up higher, bring those yields lower and stocks higher? Possible, right? We'll have to wait and see what the reaction is from the markets, but that's where you could get that melt up scenario in equities where if data starts to come in weaker, inflation starts to come in weaker, the Fed's like pause, and nothing looks like it's too, drastic. Nothing's really breaking that hard yet. No credit event yet. Then yeah, you could see equities actually make all-time highs again. Either all-time highs or just kind of stay in a range till they figure out where the heck is the Federal Reserve going and how do they feel about weak data, right? Weak data, what's going to be really important to spot in the behavior of equities is how do they react to weak data. We've seen in the past that weak data has been actually good, right? Strong data bad for stocks, which it happened initially, right? But weak data is good for stocks because it means equities will go higher. So we've seen that in the past. Will that change? That's the key question in the next coming 3 to 6 months. Will that change for equities where weak data starts to be bad? Right? Weak data starts to be bad for equities because it may mean that the economy is really, really contracting here. And the yield curve. When you look at the yield curve, it has flattened a little bit, but if we start to see that steepening again come back in, and the steepening happens quite aggressively, that could also signal that unemployment rate might start to pick up, and the jobs number will start to get worse off, and there's softening happening in the economy, which means recession, which means no soft landing, right? So if the narrative is soft landing, let's say we do get all-time highs and everyone's saying, oh, you know what, it's soft landing. What will happen if there's no soft landing? It will make the equity markets really sell off because that's not what they're pricing in right now. So very interesting to see how the jobs number, the non-farm payrolls number came in stronger. Equities and bonds to sell off. Although, yes, the average hourly earnings came in weak, but then just to reverse. And then after you saw a couple days of the markets rallying and going up higher. So let me know what you guys think. Leave a comment below. Subscribe. Hit the like button, bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.